worst case, you have to look back to the dot-com era when Amazon dropped 95% during that.
Hello everyone and welcome to the Daily Crypto. We are back with another video and are joined by Gareth Soloway once again. But before we dive into the video, let's take a look at the Fear and Greed Index for today. As of recording this video, the FNG index is at 24, up slightly from yesterday's 20. Currently, Bitcoin is trading for 19,090, whereas Ethereum is going for 1337. With that being said, let's continue with the video.
So I think the key here is to just understand what type of market we're in. When you're in a bear market, it takes a lot to get price to go up because people are scared, right? So, if you're in a bull market, you could have the tiniest bit of news and price will rip up. It could even be news that's not relevant. And we've seen stocks like GameStop, AMC. I mean, all these things just go to the moon. But the problem is we're in a bear market, and in a bear market, people really need value. They need to know that something is immediately changing, and the merge isn't doing that, right? Yes, long term, it's probably fantastic for Ethereum, but in the near term, what is everyone focusing on? The Federal Reserve, interest rates, the US dollar, the economy, and all of those things are just crushing risk assets right now. So it was kind of a no-brainer to me that you saw a kind of an early front-loaded run up a few months ago, and then it just kind of came right back in.
While many investors were speculating on Ethereum post-merge, the price didn't take off like they were expecting it to, and instead, it dropped quite significantly. During bear markets like these, it takes a lot of effort to push the prices up because everyone is too scared to buy.
Well, I mean, the narrative that has changed is the Fed has continued to be so hawkish. I mean, much more hawkish than even I thought they would be. I've kind of been in the conservative groove where I'm saying to myself, all right, the Fed needs to be careful here, because if they do tip us into a bad recession and inflation is still above the 2% mandate or 2% sub-mandate, then how do they get us out? The markets are going to look towards the Fed and say, hey, could you mind printing some money and get us out of this like you have for the past 20 years? And the Fed's going to be like, can't do it. We don't have 2% or under inflation. We can't print the way out. And I think that's starting to kind of have an impact here, where the Fed is just so hawkish and just kind of gangbusters ahead. It almost reminds me of an emotional reaction. They know they messed up printing too much prior. Now they're trying to make it up with another wrong, and two wrongs in this case do not make a right. So the markets are headed down. I think we're oversold near term, so it wouldn't shock me to see a bounce next week. But at the same time, I still think the COVID highs just before March of 2020, that has the target written all over it by year end. And again, that's at around 3,385, so 3,385 on the S&P 500.
Even Gareth is surprised by the hawkishness of the Fed, as they surprised everyone by hiking interest rates by 75 basis points for the third time in a row now. This is going to be devastating for the economy and financial markets. So much so that Gareth thinks the S&P 500 index could retest the lows at 3,385, which is a significant drop from current levels.
Right. So you're right. 75 was a no-brainer. It was going to happen. The Fed doesn't like surprising on interest rates, so they basically telegraphed 75. The markets had priced that in. What it was when they came out, they raised expectations for the next few hikes. And that's what shocked the market. So it's almost like a stock reporting earnings, right? So the earnings came out in line, but the Fed raised guidance on interest rates. And that's really what kickstarted the selling pressure, because then the dollar took off. Look at the 10-year yield. I mean, the 10-year yield is above 3.7% now. The 2-year is well above 4. I think it kissed 4.2%. That's an incredible inversion and a very scary thing. And one thing that I think, and again, it blows my mind the Fed's not kind of talking about this, or maybe not aware, but when you go back to Volcker back in the 80s, he kind of had this stutter step where he raised from 12% to I think about 18%. That's about a 50% hike in interest rates at the time. Now think about the difference in interest rate hike percentage-wise from where we were until where we are now. We were basically at 0, and now the Fed has us what, at 3.25? I mean, percentage-wise, this is an enormous hike, way more than Volcker back then. and it's going to have a major impact on the economy. And again, this is what scares me about things is like, you know, it's one thing to say, oh, you know, if we go into recession, the Fed can save the day by coming in and, you know, doing what they've done. But if you have inflation that's sticky around 4 to 5%, which is what I think it's going to be, how do you get us out of it? And are we going to be in a protracted, a long-term bear market?
By increasing interest rates, the dollar gained in strength and we saw a huge rally. This is why we saw risk assets get wrecked left and right, particularly tech stocks and Bitcoin. Gareth says this was yet another wrong move by the Fed, and we will have to face its consequences in the near future.
So I think the key is this, and this isn't being talked about very much in the media, but it's really worth noting, is that the last 2 nights, Japan has intervened in their currency markets to prop up the yen. And what they're doing to prop it up is selling US bonds, right? They're dumping bonds on the open market. But when you sell bonds, what happens to interest rates? It pushes interest rates up even more. So not only do you have a Fed that's saying, hey, we're going to keep raising rates, even after this last 75 basis point hike, we're upping our guidance by year end over 4%. But now you have other countries saying, hey, listen, our currencies are getting crushed. It's hurting us. We need to now prop these up. We're going to intervene and then actually add to kind of the pain that we're seeing on the interest rate front. So it is a wacky situation. And it reminds me of almost going back to 2008, where things started to break, right? Where we started to have the derivatives market and all of these different things start to break down. And again, if the Fed is watching, be really careful here.
The Japanese government is making efforts to step up its currency by dumping US bonds in the open market. Even though it will strengthen the Japanese yen, interest rates will automatically increase as a side effect. According to Gareth, it has started to look like right when the economy started to break down in 2008, and there seems to be nothing that can be done now.
Look at oil today. Oil's in the mid 70s all of a sudden, or in the mid to high 70s. It was just a few months ago well above 100. So you are seeing inflationary pressures kind of ease a little bit, but what's not easing right now, and I think this is why the Fed is being so hard-nosed, is that the labor market is still demanding higher wages. And wages, again, and this is something that I've talked about before, is that when a company has to double the salary for an employee, they can't just double the price they're charging for a widget, right? So what they do is they'll raise the widget by 10% this year, next year 10%, 10%, 10%, and they make up for it over time, getting their margins back in line. And I think that's the key, is why it's going to be remaining sticky on the inflation side. The input costs are coming down, those will come down, but you have that wage issue that is still sticky.
With inflation slowly coming back down, commodities are now trading for much lower prices than they were a few months ago. Just look at how oil has now dropped to $70 per barrel from well over $100. However, the labor market is still demanding higher wages, and even if companies increase them, they will have to gradually increase the prices of their products over time. This will become an endless loop of inflation, benefiting no one.
I do think that the labor market will start to weaken, right? I mean, it's just the nature of it. Almost every single day, and I pay attention to the stock market and the news. There's always there's a new company that says, hey, we're going to lay off 10% of our workforce. We're going to cut X amount of spending, and all of those will loosen up the labor market a little bit. But I think the key is that it doesn't negate the shock that we already saw, where people at McDonald's or people at these different places are now getting, double what they were getting, $25 an hour or so in salary. Now, you're not going to see those salaries go back down. They may not continue up, but they're not going to go back down. And so you have these businesses that have to figure out a way over the next few years to kind of come back in line with the margins that they had before. And that's where you get this kind of stickier inflation that doesn't get down to this 2% or sub 2% mandate. And I think even the Fed in the statement, they said they don't expect inflation to come down to 2% until 2025.
Gareth believes the labor market will eventually lose its power as companies will keep trying to cut their expenses by laying off employees. Even though some organizations have increased the wages of their employees, they will not increase them anymore for a long time.
Yeah, so you can see you're basically just hugging a little bit of support right here. If the dollar continues to strengthen and the Fed seems to want to make sure that it does, then you're going to break this 18 to 19,000 level, and your next stop is not really until that 12 to 13,000 level. That's my best case. That would be if everything works out and everything is fixed and so forth. Worst case, you have to look back to the .com era when Amazon dropped 95% during that collapse. And if that's what crypto's going through, you could be looking at a $3,500 worst case scenario target on Bitcoin.
Bitcoin seems to be hanging by a thread at this point, as this is its final chance to bounce back up, otherwise it will continue to freefall into the 12-13K range. Gareth has a worst-case scenario of 3,500 if we were to see something similar to the dot-com crash where stocks lost 95% of their value. Thank you for watching this video. Please support us by liking this video and subscribing to our channel, because we upload informational content like this on a daily basis. See you guys in the next video.